Hi, my name is George Dagnino. I'm the editor of the Peter Dac portfolio. The purpose of this video is twofold. One is to see where we stand on the business cycle, because depending on its position, we should have an aggressive, high beta kind of investment strategy or otherwise defensive. This would be just a short review. Then the second part, I would like to show you, I have 8 indicators. I will show you 4 of them. They have I think, a good track record of signaling uh, where the market is going. So I will review those for both the S&P 500 and the Nasdaq. Several economists are saying that the economy is going to go into a recession. Other people are saying the economy is slowly picking up. So that's important to know where we're going. In other words, are we here at the end of a period of contraction, or so therefore waiting for in the process of picking up growth, which means cyclical stocks usually are the strongest one, or are we still slowing down, heading into a recession, which means instead there should be a defensive investment strategy. The purpose of the next few slides is to show you what the data are saying. This graph shows the Purchasing Managers ISM survey results and shows about the manufacturing, the strength of the manufacturing. Now, when the index is below 50, which is somewhere in here, it means that the manufacturing sector is in contraction. So the manufacturing sector right now has been in contraction since 2022, end of 2022. And this is really bad news, because I believe that the manufacturing is the keystone of any economy. The fact that we are buying manufacturing products mostly from overseas and just relying on services is not what a healthy economy is all about. So I follow a lot the manufacturing sector to tell me what's going on. And right now, the manufacturing sector is again in contraction since 2023. So it's 2.5 years roughly. And this is bad news. Of course, you heard about the bifurcated economy. The top 10% are doing well, but this index of consumer sentiment, which is probably the other 80-90%, are not doing well at all. The consumer sentiment is at the bottom of the bottom, like in 1980, at the level of the 80s, which were, or the 2009, which were very deep, prolonged period of contraction, or not favorable period. So the majority of the population is not doing well. And this really is in line with the data from manufacturing, which, by the way, is important because this is where the money is. In manufacturing, there are much higher wages because the process of producing goods is much more complex than producing balance sheets, for instance, or an accountant. That's why they're paid so much more. But it's also true that there might be light at the end of the tunnel. And the Empire State Manufacturing Survey run by the Fed, it shows the index slowly improving. And this is good news. In other words, yes, the manufacturing sector is in deep trouble overall in the United States, but in some sector of the economy, areas of the economy, it shows some improvement. And this is very good news. On the other hand, economic optimism index is not doing well at all. It's plunging, and people don't feel comfortable about the economy. So this is a negative, definitely a negative. It shows that the economy is not as vibrant as people would like to see it. As you followed my writings and my previous videos, you know that I follow closely the housing sector because it's around 15% of the economy, and right now is in deep trouble. This is existing home sales. As you can see, they're very low, well below levels of the last 10 years. So this is really bad news, and it could have a very important impact on inflation. And this is what I'm referring to. The black line is the home prices uh, year over year. The green line, which is an important line, is a listing price per square foot. And as you can see, leads, because it's released 1 month late, instead the home prices are released with 2 months late, it is leading home prices down. This is very important. Why? Because as you can see here, major top in inflation, both home prices and listing per square foot lead the decline in inflation. So what I'm saying is, yes, inflation, the blue line here, is going up from 2.4, 2.5 to now is 3%. However, this sharp decline in home prices, a slowdown in home prices, is going to take down, keep inflation under control, and is going to push inflation down quite a bit in 2026. That really what this declining trend in home prices is saying. Why? Because home prices and real estate prices are a major component of the CPI. So what I've been saying is, what are the economic data? What are they saying? With the manufacturing still in contraction, maybe some improvement, but still very slow and contracting. Employment in manufacturing is also contracting. Things are not vibrant, to say the least. So the business cycle is more in a position close to phase 4 than phase 1 or 2. So again, the strategic implication is that it's more defensive approach to the stock market than aggressive growth oriented strategy. So now let's switch to what is the stock market? What are our indicators saying about the outlook for the stock market? I have indicators are based on advanced decline. I will show you based on volume of stocks rising or declining, new highs, and then only volume of stocks rising. So these are four indicators that have been both for the S&P 400, so S&P 500, and the Nasdaq. Now on the Nasdaq, they're all negative, so they're all below the buy, they're all in bearish territory. As you can see, these indicators they are what are called oscillators. They're computed from advanced decline line, and when they are above this red line, the market is going up. When they're below this trend line, the market is not doing much, and it pays to be defensive. Now, all these indicators are not perfect, obviously, but it gives you a sense of the direction of the market going up. It gives you a sense of risk here. It gives you a sense of risk here. So they all behave roughly the same, although they're computed from different different indicators. Now, right now, this has been going positive territory. However, in the last few days, this has turned down. So it doesn't give the impression of a strong market like in this case, or in this case, or in this case. Here went up, but now is already turning down. So it is a lukewarm buy signal, if you wish. The same indicators on computed for the NASDAQ, they are negative. They are deep in negative territory, and they are in a sell territory. This indicator in at the bottom is computed using volume of rising stocks and declining stocks, and has more or less the same pattern of the previous indicator of advance using advance and declines, and has the same bullish and bearish tone, bullish here. Now, has been going up, but as you can see, this rally that we see, the market is not strong enough. It's already turning down, and is a buy signal, but with some doubt that is really, especially now with the weakness of the market over the last couple of days. And the same indicator for the Nasdaq is instead is deep in bearish. So this is mildly bullish, but for the Nasdaq is bearish. This indicator is computed from new highs and new lows. Now, the previous indicators were barely using advanced decline and volume up, volume down. It was telling you that breadth is improving, but not enough to create a strong momentum. If you look at now at the new highs, new lows, this indicator has the same performance basically like the other one, and has been bearish during this period. And during this period, as you can see, was again, it's not perfect because it gave a buy signal at this point. But again, directionally is important to have it. Now here it gave a sell signal by going below this line. So it's saying, yes, the advanced decline is mildly bullish, but it's not strong enough to create new highs, new lows kind of breadth that says, gee, a lot of stocks are reaching new highs. So it confirms what the previous two indicators are saying. Don't trust the advanced decline line because there are a lot of problems with that. The same indicators using for the Nasdaq is negative, is in bearish territory. This indicator is computed only with new highs. So when there is a lot of new highs going strong, then this indicator goes in a bullish territory and the market goes up. When the new highs decline, and there are many, despite the market going up, it gives be careful because the market is not going to do much. Here has been negative correctly, here has become bullish, but recently is bearish again. So again, it's saying, confirming what the other indicators are saying, is that the market has been going up, but slowly breadth has been contracting and the rise has been on fewer and fewer stocks. The same indicator using the Nasdaq is bearish. This is a survey of money managers, and they're asking, about what percentage of their exposure is in equities. And when it goes down, it means that they are reducing the exposure in equities. When instead is rising, it means that they are increasing the equity exposure. What, as you can see, when this exposure index declines, obviously they become defensive, and usually the market is with a period, for instance, here been declining, and for 2 or 3 years, this indicated the market has not done anything. So here they have been declining the exposure, and the market has not done much. So right now they are decreasing their exposure to equities, so they are becoming more conservative, and this is also another sign of caution, despite the market going up like in this case. So what are the key takeaways? The key takeaways are the economy is slow. Manufacturing is in contraction, and you cannot have a strong economy with the manufacturing sector in contraction for 2 years, in employment where there is the high-paying jobs, employment declining. So business optimism is declining. Consumer sentiment of the 90% of the 60-70% of the population is rock bottom at recession level. So the economy is, to say mildly, is very fragile, and it's not really, it doesn't give any information about a boom coming. It's not in the cards. From a stock market viewpoint, breadth has been improving. However, all the indicators, technical internal indicators of the market, are on a sell signal or mildly bullish to say the least. For the Nasdaq, all the indicators I review are negative. So what I've been saying in my publications to my subscribers, I've always been saying, be careful. And it looks like now there is a correction in the making, and so we have to be extra careful. Thank you for reviewing this video. I really appreciate it. I hope you give you information on what the current data are saying about the economy and the markets. I thank you very much, and I really hope to see you soon. So long.